Are you active in DeFi, swapping tokens, staking, or providing liquidity? Then you need to understand your tax obligations because the I.R.S. is watching. Unlike traditional finance where brokers handle much of the reporting, DeFi puts the burden squarely on you. In this video, we'll dive into how the I.R.S. taxes common DeFi activities like D.E.X swaps, staking rewards, and liquidity pool income. We'll also cover a crucial recent change, the repeal of the DeFi broker reporting rule, and what that means for your 2026 tax season and beyond. Knowing these rules is essential to avoid penalties and stay compliant. Here's a critical update. On April 10, 2025, President Trump signed SJ RIS-3 into law, repealing the Treasury Department's DeFi broker reporting rule. This rule, finalized in December 2024, would have required DeFi protocols to issue Form 1099-DA to both you and the I.R.S., but it's gone. This means DeFi protocols will not be sending you 1099 forms anytime soon, and the I.R.S. can bring back a similar rule without new congressional authorization. However, and this is super important, this repeal does not change your individual tax obligations. You still have to report every single taxable DeFi transaction. It simply removes the reporting burden from the protocols, not from you. Centralized exchanges will still issue 1099-DA forms starting in 2025 under the Infrastructure Investment and Jobs Act. But for DeFi, it's all on you to self-report. So, how are your D.E.X swaps taxed? Every single token swap on a decentralized exchange, whether it's Uniswap, SushiSwap, or any other, is a taxable disposal. The I.R.S. views cryptocurrency as property, just like stocks. So swapping one token for another is treated like selling one stock and buying another. Let's say you swap 2 ETH with a cost basis of $3,000 each for 10,000 USDC. Your proceeds are $10,000, your cost basis was $6,000, resulting in a $4,000 capital gain. Whether it's a short-term or long-term gain depends on how long you held that ETH before the swap. Gas fees paid for the swap can usually be added to your cost basis, reducing your taxable gain. It's the most conservative and accepted approach, even without specific I.R.S. guidance. What about staking rewards? According to I.R.S. Revenue Ruling 2023-14, staking rewards are taxed as ordinary income. This happens at the fair market value of the tokens at the exact moment you receive them, specifically when you gain dominion and control over those rewards. For most proof-of-stake networks, this means when the rewards hit your wallet. These rewards are treated as ordinary income, not capital gains. You owe tax when you receive them, regardless of whether you sell them immediately. The fair market value at receipt then becomes your cost basis for any future sales. If you later sell those stake tokens, you'll pay capital gains tax only on any appreciation above that cost basis. For 2025, ordinary income rates can range from 10% to 37%, depending on your tax bracket. High-income taxpayers might also face an additional 3.8% net investment income tax. Providing liquidity to an automated market maker, or AMM, like Uniswap v3 brings its own set of tax complexities. When you deposit tokens into a pool and receive LP tokens in return, this might be a taxable event. The I.R.S. hasn't issued specific guidance here, but the conservative view treats this deposit as a taxable exchange. You are disposing of your original tokens and receiving a new asset, the LP tokens. So you might trigger a capital gain or loss right there. Then any trading fees or incentive tokens you earn from providing liquidity are considered ordinary income, just like staking rewards. These are taxed at their fair market value when you receive them. It's a lot to keep track of, and clearly the I.R.S. expects you to understand these nuances. Even though DeFi protocols won't be sending you 1099 forms, don't think you're off the hook. The I.R.S. has invested heavily in blockchain analytics tools. They can, and do, trace on-chain activity directly back to individuals. This means that even if you're deep in DeFi, your transactions are not anonymous to the I.R.S. They're actively using this technology to identify non-compliant taxpayers. The responsibility to accurately report every single D.E.X, swap, staking reward, and LP income event falls entirely on you. Failing to do so can lead to significant penalties, interest, and even criminal charges. Staying compliant is not optional, it's a necessity. This is where tools like dTax become essential. Manually tracking every single DeFi transaction, especially with complex LP events and numerous swaps, is nearly impossible. D.E.X simplifies this by supporting 18 different blockchains, including 16 EVM chains like Ethereum, Polygon, and Base, plus Solana and Bitcoin. It automatically tracks your DEX swaps, NFT transactions, staking rewards, and even LP tokens. With 8 different cost basis methods, including FIFO, LIFO, and HIFO, D.E.X can help you optimize your tax outcome. It's free for up to 50 transactions and offers a pro plan for just $49 a year for unlimited transactions. Check out getdtax.com to get started and simplify your DeFi tax reporting. Navigating DeFi taxes can feel overwhelming, but understanding these core principles is your first step towards compliance. Remember, the I.R.S. expects you to report everything, even without 1099 forms from DeFi protocols. Don't leave yourself exposed to potential audits and penalties. Stay informed, use the right tools, and make sure your crypto taxes are in order. Thanks for watching, and we'll see you in the next one.